problem is most people are recommending gold. I'm like, look at 2008. Gold kind of held up early, and look at, in the worst, in the third and fourth quarters, gold went down 45%. Not the worst place to be in the first fight, but it was not the safe haven. The treasury bonds went up the opposite, 45%.
The big distinction is, there was a thing called junk bonds and this bond and corporate bonds and all that. So you're saying government backed, like the U.S. government?
Yes, AAA corporate, and in the world, even, who's the best house in a bad neighborhood? Already been through. Is Europe in trouble? Yes. Has Japan been in trouble forever? Yes, okay? U.S. is still the best house in a bad neighborhood, and our bonds went up in 2008 crisis, 45%. Treasury bonds, 30-year treasury bonds, and they're going to go up more than that this time. So you go to the safest places. Again, where can you get predictable rentals, even in bad times, from real estate? And that's from apartments and multifamily. And where are the best bonds that will be paid no matter what, when all financial assets have to go. And here's my number. From 600 trillion worldwide, they're going to have to come back down to about 250 to 300 trillion. Now, think about that. Globally, 3 times global GDP 95, $300 trillion, give or take, 250 trillion, disappears in financial assets and doesn't come back for a long time. That's the big news in the next coming years. So as long as you're protected from that, in the right real estate and in the right bond, the highest quality, longest term. If I could buy one thing, it'd be a 30-year treasury bond.
Okay, U.S. government.
U.S., not Tanzania.
What kind
Not
of...
even Europe. Europe has much worse demographics and already been slower than us. U.S. as a developed country is going to come out of this after a damn near short-term depression, the best. And our millennial generation, Europe doesn't have one, by the way, okay? Is going to be the best in the developed world. So we come out of this better, and our bonds, our U.S. Treasury bonds, 30-year Treasury bonds would be my #1 recommendation right now. And if not that, you buy ZROZ, Z-R-O-Z, which is an ETF that balances 20 and 30 and leans towards the 30, so 25-year average.
Would you give that? We don't make recommendations, but if you do it, we'll let it go. What do you think is the best ETF?
ZROZ is a 25-year average, so it's a blend of 10 and 30-year treasury bonds. They lean towards the 30. TLT is about 50-50, okay? So the ZROZ ETF will go up about 50% faster than the TLT, and the TLT has already done very well since this crisis set in at the top and will be much better when we get it to work. In 2008, the worst of it was in late 2008, TLT and ZROZ went to the moon.
Good. Thank you. That clarifies it, because in my mind, I still remember junk bonds and all that stuff.
Junk bonds. So the highest risk bonds go down the most, more like stocks, right. And the highest quality, like 30-year treasury bonds, go up the most as the safe haven. And gold, which did well in the early parts of the last 2008, went down 40 to 45% in the latest stages. So gold was not the worst place to be, but in the end, it went down with everything else. Gold, I'd rather have gold than anything but these treasury bonds.
Right. You said something. Why doesn't Europe have a millennial? What happened there?
Because they're older, they've been around longer, they've been richer longer, and people who are rich have fewer kids. Poor people have more kids and rich people have fewer. You know that. You're a rich dad guy.
I understand that, but I didn't know Europe.
We should promote rich people having more kids, but the natural propensity, people that have a life say more kids ruins that life, and it's better to have 2 kids and be done. Poor people just keep having kids.
And to your point here about multifamily, it's exactly what we're seeing, because we do have a lot of multifamily. Rents are going up, demand for apartments are going up.
If you have something where the income only goes up when all stocks and earnings are going down, is that not attractive? Of course it is.
Very attractive. I have a question, and I don't understand this. So I was told recently that the yield on short-term bonds is actually greater than long-term bonds. Does that make any sense?
Yeah, and it should be the opposite. long-term, you're taking greater risk, so it should be higher. But when people see a downturn and deflation in prices and inflation going down and maybe going negative into deflation, then that's why those yields respond differently. That's a short-term phenomenon. And what I want to do now, and the biggest thing I get is people say, Harry, you're recommending 30-year Treasury bond. I'm not, I'm recommending them for the next 20, 30 years. No, they're for the crash. They're the safe haven in the crash, more than gold, way better than gold. And when the crash happens, I don't want to hold 30-year Treasury bonds at 1 to 2% yields or zero. I want to get back into the best part of the world, and it's not going to be North America anymore. It's going to be better than Europe, but Asia is going to be better than North America and continue to be. That's simple. There's nothing simpler than demographics than that. We're better than Europe in the developed world, and as things move forward, all the growth is going to be in Asia, East Asia, going towards India, which after I die will be the richest, greatest, largest country in the world.
So that makes sense. That makes sense.
After I die, so I'm not going to get to see that one. I'm not going to be able to claim that.
You never know, Harry.
You can put it in writing, but you got it in writing, so that's good.
I got it in writing, yeah.
Yeah. So
But
now
my grandchildren will realize I was smarter than they thought I was.
Your bond play is just kind of a short term for the crash.
Oh, it's totally short term.
Put it in other assets.
And again, the problem is most people are recommending gold. I'm like, look at 2008. Gold kind of held up early, and look at, in the worst, in the third and fourth quarters, gold went down 40, 45%. Not the worst place to be in the first fight, but it was not the safe haven. The Treasury bonds went up the opposite, 40, 45%.
Right. I'm glad I asked you, because I don't have any bonds. So I was just, I look at an apartment house as a bond, if you know what I mean.
It's a high yield investment. I agree with you. And a stable, again, people are only going to trade down to multifamily, not up to expensive houses that are overvalued. So no, that's the defensive part of the real estate market. I'm saying the highest quality government bonds, particularly U.S. Treasuries, is the best defense in a crash.
That's fantastic. That's fantastic. Distinctions that we don't have. I got one more question though. When interest rates were coming down, the price of bonds were going up or something like that?
Yeah.
Why is that?
Because if you locked in like say a 5% 30-year Treasury bond and yields now move down to 2% because of lower inflation, who's worth more, your 5% 30-year Treasury bond or the new 2%? Your 30-year is worth a lot more now. So bonds appreciate when inflation comes down, especially the highest quality long-term. Now, a junk bond will not act the same. It'll say, inflation's coming down, but default risk is going up, and I'm a junk bond, so I got higher default risk. So that's the difference. In a crash like this, a deflationary crash, it is the highest quality U.S. government or AAA corporate bonds, which are the best. And between those two, why would I choose a AAA corporate when I can get a 30-year Treasury bond, which they will not default on, even if they have to print money?
Going back in history, wasn't Ivan Boesky, wasn't he the junk bond king or something like that, or one of those characters?
I'm not an expert in Ivan Boesky. I understand, but it is interesting to study other places that have had inflation and crashes. I keep seeing people say this is going to turn into hyperinflation. No, it's not going to take much more inflation. It's already crimping our economy and bonds and stuff, and that's already going to lead to a downturn. I'm telling you, when we see this downturn, I think we're already into it. It's already starting now. Inflation will disappear at 9.1% or 10% if it gets the height, and never appear in the rest of our lifetime. That's a forecast.
Wow.
Never see inflation above a few percent for the rest of all of our lifetimes, even if you're 20 years old. That's my forecast. Because inflation was the major baby boom entering a great expense, and that caused a huge inflation. And you know what follows huge inflation? The disinflation and the boom that follows from that generation that caused it, and blah, 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 blah. We're not going to ever worry about inflation in the developed world again. Hey, maybe Zimbabwe, maybe Africa, but we will never, high inflation will never be a topic after.